So last time around, the first 100 days were very busy. We saw 24 executive orders, 20 presidential proclamations and 28 bills enacted within those first 100 days. 12 of those bills rolled back regulations that were brought in the last few months of the Obama administration. So yes, I expect it to be a very busy 100 days. What are going to be his priorities? I think he'll be focused on tax cuts. So he made a number of tax cuts in his previous presidency that are actually due to expire this year. So I expect those to be a priority to continue them and maybe even deepen those tax cuts. So that should be a focus in the first 100 days. He's talked about scrapping the clean energy tax credits, so I expect that to actually take place. What else are we expecting? I think we should be looking at tariffs. He's talked a lot about tariffs against the key trading partners for the US, so the likes of Canada, Mexico, China. So I do expect those tariffs to be implemented. Last time around it wasn't just rhetoric, those were implemented, and I expect that to be the case this time. It may well be a negotiating tool going forward, and they may then be pared back, but I do think they'll get implemented early on. Foreign policy is also likely to be a key priority. He's talked about obviously the conflict in Russia and Ukraine, as well as the Middle East. He's obviously talked about ending that conflict in Russia and Ukraine within 24 hours, which I think is going to be a tall order. But obviously it'll be closely watched. Certainly from a European perspective, it has the potential to have a big impact in terms of geopolitical stability, but also on things like energy prices and inflation here. So that's going to be keenly watched, but he's talked about that as being a key priority. And finally, he's also talked about more domestically focused priorities like border control and immigration. Recently, that's sort of reduced in terms of the wider rhetoric of lots of deportations, but certainly a focus on for example, criminal deportations in the early days. So I think those are the key priorities, and I expect it to be a busy first 100 days. So there's a number of opportunities potentially out there for investors post Donald Trump election. We have already seen that he's continued to threaten increased tariffs on key trading partners, be it Canada, Mexico, China, and I expect that to come to fruition. What does that mean? Why is that positive for investors? Well, it certainly should be positive for US manufacturing, so it's about protecting US manufacturing. So from a US domestic perspective, it should be positive. The manufacturing sectors, industrial sectors in the US should do well, so that's an opportunity for investors. Elsewhere, we've obviously seen and heard a lot about Elon Musk and his involvement, and I would expect, and we've already seen this, that the tech sector will continue to do well. It's a story, I guess, of less regulatory pressure on that sector, and also, I guess, more supportive, and that's in addition to obviously what is a structural growth story there, the tailwind of AI. That story's not going to go anywhere. And then in addition, you've got that added benefit of Trump being a far more friendlier president towards that sector in general. So that should continue to do well. We've also talked obviously about the potential for tax cuts in the US. So a Donald Trump presidency is expected to see further tax cuts. The US small cap market should be key beneficiaries of that. We've already seen the US small caps rally quite strongly. I expect that to continue. Elsewhere, there's a few sectors that have benefited already and should continue. So elsewhere, we've got the clean energy sector, which has been negatively hit because it's obviously seen as less beneficial for that area. But energy more generally actually has rallied quite strongly, and I suspect and expect that that'll continue as again it's a deregulation kind of story behind that, more favourable policy towards energy generally. So that should continue to do well. The same story applies, I guess, in the financial sector. Financials have done well, and again, if we think things like bankers' bonuses, the sort of pressures around that, regulatory pressures around banking and the financial sector, that should dissipate. Trump is seen as a much friendlier president to that sector, so again, it's rallied quite strongly. So an initial impact we could see in the UK is that of tariffs. So President Trump has talked about tariffs a lot. He's talked about tariffs on imports being somewhere between 10 and 20% into the US market. We don't do a lot of trade exports into the US, but obviously 10 to 20% tariffs would have a large impact on those exports that we do. However, a bigger part of our export market into the US is actually services. So from an overall economic impact, it should be fairly negligible. More interesting, I guess, is how that affects any kind of US-UK trade deal. And I think that could obviously have a negative impact if we feel like the US has leverage with these tariffs. We might enter into a slightly less beneficial trade deal with the US. But overall, I'm not sure that tariffs are going to be a big impact for ourselves. And in fact, if we avoid tariffs, we might be able to actually do a bit more in terms of trade exports into the US, where others have stepped back because of the high levels of tariff. From a UK perspective then, actually the Ukraine-Russia conflict has much more of an impact, I think, in the near term. So whichever way that resolution goes has the potential in terms of food prices and energy costs. We saw in the early stages of that conflict the negative impact on inflation following energy prices increasing, following food prices increasing. So if that resolution goes in a way I guess the UK would not like, and indeed the wider Europe would not like, I expect that to be negative from both an inflation perspective, price increase perspective, but also therefore interest rates. So we've seen positive moves in interest rates and inflation in the UK. It's been beneficial for the economy, it's been beneficial for markets. The opposite is obviously true as well. So if we see things going the wrong way, we will see the increase in interest rates, we'll see a potential increase in inflation, and therefore negative impact on markets. Not to mention, obviously, a keen focus on geopolitical stability. Markets don't like instability. If we see further instability in the region, that's likely to be negative for both UK markets and indeed Europe as well. Surprises with the Donald Trump presidency tend to go hand in hand, so I expect there to be quite a few. In terms of trying to forecast one, I guess I'd look at the US dollar, and what I mean by that is the strength of the US dollar. At the moment, we're talking about tariffs and the fact that Donald Trump is likely to bring in a number of tariffs with key trading partners. I think that happens, but perhaps the surprise is that in the medium term, that's actually used as a negotiation tactic. So impose those high tariffs and then say, look, I can bring these high tariffs down, but there needs to be a quid pro quo. That being a devaluation in the US dollar, so a lowering of the US dollar. So if you think the US dollar is the reserve currency across the globe pretty much, a strong dollar means other currencies weaken. The opposite's true. A weaker dollar means that other currencies strengthen, and that helps economically. So what we could actually see is that we see good economic growth going forward, triggered by the devaluation of the US dollar somewhat. Time will tell, but that could be an interesting surprise for the global economy.